Just when you thought a company couldn't pivot any harder, the founder takes back the CEO job, calls his own sales team unspeakably horrible, drops $69 million of his own cash on the stock, and fires a third of the company. Welcome to Earnings Unscripted. It is June 3rd, 2026, and today we are tearing into the Q4 results for C3.ai, ticker AI. And actually, before we dive in, just a quick reminder that this is definitely not financial advice, just our personal opinions, so please don't base your trades on our little therapy session here. But seriously, Miro, the headline revenue was $51.6 million, down over 50% from last year. It barely even feels like a financial report. It feels like, I don't know, a hostage negotiation? What is your read on this?
My read is that Tom Siebel got tired of watching from the sidelines. Look, the top line is bad. You said it, $51 million. That is a sequential drop, too, down roughly 3% from last quarter. But the real story here is that they are completely reversing the consumption model they spent the last 2 years building.
Wait, they spent so much time convincing us that those initial production deployments were the future. Like, that was the whole pitch.
Exactly. The IPDs. They only signed 9 of those this quarter, down from 14. So Siebel comes in and basically admits the sales strategy narrowed their pipeline to nothing, and now they are actively shifting focus back to hunting massive enterprise whales, the $5 to $2 billion transformational contracts.
Right, which takes a totally different sales motion. And speaking of motion, the stock tape was just giving me whiplash. The stock had already ended the quarter down almost 19%, right? Then today, it closed the regular session down a bit, and immediately after hours, it spiked to almost $13.
Founder premium. The algorithm saw the massive insider buy.
Yeah, but then within an hour, it just completely rolled over. It gave back the entire spike and settled down over 2%. It was like the market got hyped on the drama and then actually, read the operating loss.
Yeah, because the reality is harsh. The GAAP operating loss was negative $121 million. Now, sure, that is technically better than the $140 million loss last quarter. Earnings per share also improved to negative 79 cents. But those improvements they're practically manufactured by the bloodletting.
You mean the 35% headcount cut?
Yeah, they took the global headcount from over 1,000 down to roughly 700. That instantly shaved over $20 million off their quarterly stock-based compensation alone. SBC went from almost $76 million down to $54 million in one single quarter. It is brutal efficiency.
It really is. And the craziest part to me was when he said they're replacing the lost headcount with their own AI agentic tools to do the coding and marketing.
Eating their own dog food. Well, at least someone is using the product at that scale.
Okay, harsh. But he was just so theatrical on the call. He literally told an analyst, give me a stage and a sword and I will eviscerate myself in public.
I mean, talk is cheap. He knows the execution has been, to quote him, laughably unacceptable. So he provides the theater so Wall Street forgives the transition period. But a complete global sales reorganization is highly disruptive.
Totally. All right, well, let's actually get into the details on that transition because the underlying cash flows are telling a really specific story here.
The cash flow is exactly where the illusion breaks. They burned nearly $55 million in free cash flow this quarter alone. And look, the thing is, capital expenditures were basically zero, like $0.3 million. So they are not aggressively building data centers or anything. That $55 million is just purely bleeding from operations.
Which brings us right back to why the consumption pivot failed so spectacularly. I mean, the whole pitch for the past 2 years was that landing small deals would predictably scale up over time, right?
Right, except the execution broke down entirely. Siebel actually admitted on the call that the sales team inexplicably narrowed their global focus. They were targeting just roughly 100 to 150 accounts worldwide.
Oh, wait, worldwide? 150 accounts total? That is barely a boutique agency. You cannot sustain a publicly traded enterprise software company on a funnel that tiny.
You really can't. And that explains the 50% revenue haircut. But here's the part that actually actually bothers me structurally. It is how they're handling the fallout in the filings. Because last quarter, they leaned heavily into their the remaining performance obligation, which is just their contracted backlog. It was over $225 million.
Okay, and what did they report for it this time around?
Nothing. It completely vanished. Neither the press release nor the management team shared the new backlog number on the call.
Oh, wow. Yeah, you definitely do not hide your backlog metric if it is growing, or even if it's stable, honestly. So they're masking the immediate pipeline damage while pivoting back to these, what did he call them, the massive $5 million to $2 billion enterprise whales?
Exactly. The transformational deals. But the visibility on this new strategy is virtually zero. When an analyst explicitly asks Siebel how the product versus service mix is going to evolve with this pivot, Siebel flat out refused to answer. He said, and I'm quoting here, "I think it is a don't know." He literally told the street they really don't know what that mix is.
Okay, but how can anyone possibly underwrite the revenue guidance if the CEO is saying he has no idea what the mix looks like? That just feels so chaotic.
Well, it is. You are flying completely blind. You basically just have to believe the founder is going to brute force a turnaround using sheer will.
Which honestly feels like an enormous leap of faith when there are massive hidden liabilities lurking in the background, too. Did you happen to see the legal footnotes in the Q3 report?
Are you talking about the NL situation?
Yeah, the Italian utility giant. I mean, buried deep in the filings is this absolute monster of a lawsuit where C3 is suing NL in Italy for trade secret misappropriation. And they are claiming 2.1 billion euros in damages.
Which is an absurd number. NL is countersuing over a patent ownership, of course.
Exactly, but 2 billion euros. That is magnitudes larger than C3's entire annual revenue. It is this huge, unresolved contingent item just sitting there off stage.
It is fascinating, yeah, but lawsuits like that take years to untangle. I think the market is largely ignoring it because it's essentially a binary lottery ticket. Management certainly cannot model it into next year's cash flow. But you're right, it just adds to the total opacity of the business right now. You have evaporating backlog, no visibility on product mix, and a multi-billion-dollar fight over intellectual property happening in Europe.
It really is a scorched earth reset. They are tearing everything down to the studs. So stepping back from the record here, let's talk about what this actually means for their trajectory, because surviving a pivot this violent is definitely not a given.
It is not a given at all. And looking at their Q1 guidance, management is modeling 50 to 54 million in revenue. That is basically, well, flat sequential growth.
Right. So we are looking at a full year guide of, I think, 210 to 240 million, which means continued top line decline.
Exactly. But, and this is where we have to give them some credit, the math on their survival actually works now. By slashing a third of the workforce, they expect to fully realize those cost savings by the second half of fiscal 27. So if they just keep revenue completely flat, they actually have a real structural path to positive free cash flow.
Because they still have a massive safety net. I mean, after Siebel bought all those shares on the open market, the active cash balance is sitting at over 670 million. That buys a lot of time.
It does. It gives them, I would say, probably 2 to 3 clear years of runway just to land one or two of those massive enterprise whales.
And Siebel is aggressively defending the idea that those whales are out there. He had this amazing exchange with a Bank of America analyst where he just pointed to Palantir as proof the market is real. He said, you know, Palantir's execution's pretty damn good. And then added, even Bank of America probably believes that today. You didn't in 2016, 2017, 2018, and just kept listing the years they were wrong.
It is a great quote. And he is right about the market. But Palantir actually executed the strategy. C3 is at this point essentially a very well-funded startup again.
That is such a good way to frame it. So looking to next quarter, it really is just about watching if that cash burn starts to taper and if Siebel can actually lead this new super flat sales team to a massive win.
That is the only story that matters now. Can they close a $50 million contract with 3 layers of management? We will see.
It is going to be quite the case study to follow. All right, I think that's enough corporate drama for one afternoon.
Yeah, my spreadsheet definitely needs a break.
Thanks for hanging out with us, everyone.
See you next time.
Okay, if you like having these little earnings deep dives just show up in your feed, definitely go ahead and follow the show. Just a quick transparent heads up, this is actually an AI-generated podcast, which is exactly how we can instantly process those dense financial filings and get the story out to you so fast. We love to hear what tickers you want us to look at next, so drop us a note at earningsunscripted@datamadness.ca. Thanks so much for listening.
Take care, everyone.